What's up, guys? It's Sam here, and I wanted to talk to you about how to analyze a rental property, how to analyze a deal, and just walk you through the analysis and how really simple it is. I put together an example, and this is all. I just went to Zillow and fucking found a property and went from there. Nothing crazy. I'm not doing anything out of the ordinary. It's just that simple to go through this process. Whatever you think I missed, let me know down below in the comments. But before I do that, make sure you press that like button. If you're on Facebook, jump over to my page and press that like button. If you're on YouTube, you know what red button to press. That subscribe button. With that being said, let's get into it. And there's 5 different factors when you want to calculate the return on something. There's 5 different factors that I use to calculate the total return on something. And this is why I really love real estate. So there's the 5 different things that you're going to use. You're going to use the cash flow, right? The potential appreciation. So cash flow, potential appreciation, equity pay down. What's the other one? The depreciation on the property. And the last one is the ROI of taking action for yourself in life. I think first of all, those 5, the vast majority of people who calculate returns or ROI when they're looking at a property don't factor all those in. They look at cash flow and that's it. And it's a very myopic way of viewing returns because that's not all the pieces that go into a return. And there's other things that I could have brought in here. If you know anything about accounting, you know that you can be super creative and bring other things into this that you could. There's a big gray area that allows you to do things completely legally that can increase the tax benefits of this even more. Also, there's other things that are not necessarily factored into this, right? Where you can receive other benefits from something like this. And that's where I pull those into, if they're non-monetary, into the ROI of taking action. So I wanted to go over with you all of the numbers that I put down here and just show you the results. Also, I will do some I'll explain all these numbers and where they all came from too. But we're going to start with the property. So literally my neighborhood, and I just pulled up Zillow. Right? So I found this property, right? 107 Harris Street, Leominster, Massachusetts. This is probably 3 minutes from where I live. It's 2,500 square feet. It's a 5-bedroom. It's a 2-family. It's $220,000. The estimate right here, the $41,000. It doesn't say how it's split up, but if it's 5-bedroom, it's probably a 3-2 or a 3-bedroom and a 2-bedroom place on the property. Okay, so I took those numbers and assuming that you were not going to live in it and you were just going to purchase the property, what I did was take to come up with the out-of-pocket cost. I took a 1% of the purchase price for closing costs. And remember, when I do these analyses, I generally speaking will lean more on the conservative side with all of these numbers, and you'll see that consistently as time goes on. Okay, so we've got a $220,000 purchase price. We are going to be paying $46,000 out of pocket, and you might think, "Holy fuck! I don't have $46,000." Well, you can actually move into the property and live in one side of it or one floor of it, and rent out the other one to get in there at substantially less. And the less you put down up front, the higher your returns are. And that's just a simple math because you have the numerator and the denominator, and if the denominator, the number on the bottom, is much smaller than the quotient. The end is much bigger. It's just simple math. Okay, so also the assumption here is that the building value is approximately 75% of the purchase price. So if we have a $220,000 property, 75% of that is about $165,000. The rest is attributable to land. Now, the reason you break that up is because, according to the IRS, you can depreciate 1/27.5 of the building value per year. And that sounded very confusing the way I said it, but you get 27.5 years to depreciate the building value. I think it's on the HUD statement if you purchase a property. And it tells you what that is. So you get 127.5 of that per year as a write down on your taxes. So in this case, right, we had about $165,000 for the land, for the building value, divided by 27.5 comes out to be about $6,000 per year that we get to depreciate. That means that gets to lower our taxable income. So if you look at in Massachusetts, right, I fall in the 24% tax bracket, the marginal tax rate at the federal level. And the Massachusetts state income tax is 5.05. So if you combine those together, that's 29.05. So the after-tax dollar amount that you get, meaning the actual cash you get as a direct result from that $6,000, is $1,742. If you do that on a monthly basis, it's about $145 per month. And now to just jump into the mortgage, right? So I wanted to get the depreciation portion first, right? Because that's one of the 5 factors you use to calculate the total return on a property. The next we're going to calculate is the cash flow. So you got to go through each one of these individual pieces. And so also with the 75% of the purchase price as the land, 25% for the land value and 75% for the building value. I believe a good rule of thumb is actually at 80, so I was even more conservative with that, meaning I would reduce the depreciation amount slightly from a good rule of thumb is. I think it was around 80% for the building value of the purchase price. So if you had $1 million property, a good rule of thumb would be that 80% of that is associated with the building, 20% is associated with the land. So I was more conservative on that one. Now, what I did here to calculate the mortgage amount is we have the total purchase price of $219,900, right? We're not even factoring in a tip, a discount, or anything like that because we don't know. And we're just going to do a preliminary, so you can go in and just plug these numbers in. It's a 30-year fixed rate, and I put down 5%. But if you pay attention to the mortgage market at all, you know that you can easily find a rate that's less than that. So I did a higher rate out there. I think rates are actually slightly below 4.5. Then you have insurance. So in this case, it's $1,260 a year. And property taxes are $1,869 a year. So your total payment, so that's your principal, your interest, your taxes, and your insurance together, those 4 things together come up to be $1,205. Now we got to factor in maintenance, we got to factor in a property manager, and try to raise this finger up by itself. You can feel that in your hand, it's so hard to do. Property manager, maintenance, and snow or lawn, maintenance. Okay, so in this case, because there's 2 units, generally speaking, I like to factor in about $100 per unit. So that's $200 a month for maintenance. And you might think, like, how could you possibly spend $200 a month? It's not that you're probably going to spend $200 a month. It's that 10 months down the road, when you have $2,000 sitting there, like a hot water tank will go, right? And a hot water tank is going to cost you, $900, $800, and then it's going to cost you $200 or $300 to get somebody to install it for you. So you're paying $1,200 to $1,300 to get a new hot water tank installed. So some things like that you just let that create another account. By the way, on a separate note, just related to business, if you're doing this kind of thing, just create multiple accounts, right? So you've got your main operating account where all the rent can come in. You can put away a tax account because you're also going to have to factor in taxes at the individual level, which I did not do in this case other than the depreciation. But you can factor that in as well if you want to go even further into the analysis. So we have $200 for maintenance. We have the property management, $75 per unit. You can probably get it less, at least in this area of Massachusetts, than $150. So it'd be $150 for the property per month. You can probably get it less than $150, but you want to make sure they know what the fuck they're doing. Excuse me. Mainly in terms of, so I always want to know what's your process and what do you do if somebody's late? And if there's I call them, or if it's other than I send out a letter to them saying they're getting evicted in 30 days and there's a late fee to pay, or whatever the case is, whatever that verbiage is, they need to have a concrete policy or procedure that they follow every single time somebody is late. There's a $25 late fee, and if it's not up to date within the next 14 days, a letter of eviction goes out, and then this happens and this happens, right? It needs to be concrete for me. Otherwise, I don't care how cheap it is. I'm not going to do it. Now, in Massachusetts, there's probably snow and lawn maintenance. So depending on how you structure your leases, you could have the tenant be responsible for these things. In this case, I put down that I was responsible because not sure how other leases in the area are structured. If the area around here has them structured so that most of the landlords are responsible for these things, then more than likely it might be more challenging to have the tenant be more responsible, just because when in Rome, do as the fucking Romans, right? So that's why I factored in here. And if you got to that point where the property is under contract and you're looking at other leases and you find out that the other property managers or other rentals in the area actually have the tenants pay for that, then that is a bonus, right? An additional $100 cash flow. Same thing with the property management. With the maintenance, I wouldn't really drop that, honestly. I would just leave it, because eventually there's going to be some fucking issue, whether it's you end up spending on average $30 a month throughout the course of the year, and you have a nice little leftover at the end. Just leave it there, because eventually something's going to happen, and you'll have the cash flow. You'll have the cash just sitting there, and you won't have to do anything. You know what I mean? 20 months later, you have $4,000, and then some fucking thing happened, it's $4,000, and you just don't even be concerned about it because you have the cash just sitting right there. Okay, so now the total expenses, right? Because we have a mortgage payment, we have property maintenance, we have property management, and we have the lawn care and snow removal. The total of those, the aggregate, is $1,655. So I'm going to show you these numbers as well. And then we get into rents. You're like, well, that doesn't fucking mean anything. How much can you rent it for, right? So what you can do to figure out the rents is go to Zillow and look in the area and how much 2 bedrooms are renting for, how much 3 bedrooms are renting for. Try to get a comp, meaning something that's comparable from a quality standpoint and a location standpoint, both of those things. Location would be more important, in my opinion, than the quality. And then another site that I like to use is called rentometer.com. And with that, you can put in your address, and then it pulls up the average with a radius around your address that you plugged in. And you can put in a 2-bedroom. So that's what I did. So I pulled in a 2-bedroom, put in the address of this one, what was it, 107 something or whatever from Zillow, right? I pulled that up and plugged it in, and what comes out is $1,133 is the average for a 2-bedroom in this area. That's based on 25 results within a radius right around that location. Now the 3-bedrooms, based on 13 results, so that means it's the average of 13 different data points, is $1,412. So maybe that area happens to be luxurious, right? And these are higher end, newer properties. Like these are A's or B pluses, right? And this one right here maybe is actually like a C, right, or C plus. So maybe I couldn't get those rents potentially. But what I can do is I can take those numbers and discount them, right? Like this, that's not like this is probably like a B neighborhood over there, B minus in that range. So the rents are going to be comparable to that. And what I did in this example is I actually took a 15% discount on both of those. So the total rent is like $2,500. Let me just do this real quick. Is the 1412 plus 1133, and I took a 15% discount on that. So the total amount that I'm factoring in to be conservative, right? Because I want most of these numbers to be conservative, so that any one of them, you know what I mean, moves in the wrong direction from what's actual. I've already factored it in through 3 or 4 different types of assumptions that I've made higher than they actually are. I'm actually expecting. So I factored in $2,160 in gross rents. My little apartment here is about $1,000 a month, and I'm, maybe 2 or 3 minutes away from this property here. So the total cash flow now, right? Because that's what we were getting to next, right? We already did the return that we're going to get from the depreciation. Now we're going to doing the cash flow. So now we have the total expenses minus the cash flow, minus the gross rents. Gross just means before anything's taken out. So you take gross rents of $2,163 minus $1,655. If anybody wants a spreadsheet, let me know in the comments or reach out to me on Instagram, and I will give you a link to this so you can just go through and punch in your own numbers too if you have any questions. The cash flow is $508 per month. What's up? What's good, bro? $508 per month. Okay, so now, this last one is called, I call it LRAA, which is the long run average appreciation. So you can argue with me whatever you want in the comments. I put down 3%, and historically that seems to be about accurate. So 3%, right? Because this is a long-term rental. That's how I purchase property. So long-term rental. So in that case, to factor that in, you take the purchase price, right? $220,000 times the 3%, which is the LRAA, which is the long run average return appreciation, divided by 12. And that gives us our monthly return for appreciation on average in the long run, remember? Now, another thing that we have on here is the equity paydown. So if you know anything about amortized loans, you know that the equity paydown continues to grow over time. So if you just factored this in, right, I put it into a calculator and factored it in, looked at the amortization schedule to see exactly what the principal paydown is in month 1. I just took the principal paydown in month 1, but if you're 6 months in or something like that, then it's obviously going to be a higher number. But if we're just looking at a property to analyze it, we're going to take it from month 1. And that's $211 that are going towards principal every month. So that is a return to me, right? Somebody else is paying off my mortgage, and that money is not owed to the bank or anything. That comes to me. So if I turned around and sold the property, that would be my equity. So you don't get to see that part of the return, but it's still a return. So now the total return, and that's the one that people probably have the most difficult grasping that, because it's a little bit more contextual for some people. Then they just like to have that tangible, like, oh, I get $3 in my pocket, or whatever the case is. Where to think a little bit longer term, and understand how it actually plays out, is why those 5 things are factored into the total return on real estate. So now we have the total cash flow per month. Right? Some of that we get to see at the end of the year when we do our taxes. Some of it we get to see when we sell the property. But to get a total return number, we need to put it all on the same plane, right? Because otherwise it's not comparable. So we need to all put it on a monthly basis, and then we can annualize it or do whatever. So on a monthly basis, the total cash flow is $1,414. So $1,400 per month, roughly, right? So if you were to take out the down payment, or the equity pay down, and you were to take out the total amount that we get as a tax benefit at the end of the year, right? Because some people just have a hard time grasping that pure portion of it. And you were to take out the total amount that you get from the, total amount that you get from the depreciation, your cash flow is just going to be $508. But as we've talked about multiple times throughout this, there's other pieces besides cash flow that goes into the analysis of properties, especially as the market becomes more and more competitive. The cash flow is going to go down. It's going to shrink, as like companies like Zillow and Redfin and other companies that we haven't even thought of, and the you can buy tokens on property and like blockchain and all this other stuff. Anyways, so the monthly return on our investment, right? So that's going to be the total cash flow of those factors plus divided by